everybody. It's Dr. Joe's in the house on this Wednesday evening. Hope you're doing well wherever you are. And we've got another great session lined up. And today we're going to talk about cash flow management, specifically, staying profitable through market cycles. As we all know, real estate is all about cycles. There are ups and downs. All good things come to an end. I've been through 6 real estate cycles during my 35 years experience. And so I have a pretty good idea how this stuff shakes out. And real estate investing is really, really good during good times. The problem is that what happens during downtimes, when the economy goes south, when you can't sell your stuff, if you're flipping, you can't rent your houses, if you're trying to rent, it's ugly. And so I thought it'll be, we're kind of in a transition right now in terms of the business economic cycles. I know they reduced interest rates today. So there's a slowdown in the economy. And so I thought as an appropriate subject to talk about is, as real estate investors, what do we do? And how do we make sure that, we sustain our cash flow during ups and downs? And so I think it's an appropriate topic. And I think it's going to be interesting. So I've got a lot, waiting for you. So tune in. As usual, if you've got any questions, please put your questions in the chat box, and I'll get to them towards the end of today's session. And anything to do with real estate investing is appropriate, whether it's buying, financing, rehabbing, tenants, Section 8, whatever it is, I'll give it my shot and try and answer your questions. So please put them in the chat box, and I'll get to them about 20, 25 minutes from now. And for those folks who want more detailed one-on-one with me, I do have what I call Ask Dr. Joe, where you can, spend an hour with me, where you can book, and we can go do a deep dive into anything pertaining to real estate investing, a problem that you're encountering, an issue that you're facing, or you got some maybe a deal that you're thinking about and you want me to sort of weigh in, or you got a tenant issue or a landlord issue or whatever it is. Book a session with me, and I'll be more than happy to spend some time. I had several sessions this week. Real great one with today, Steve, Tim yesterday, Matt yesterday, and they are really, really good sessions. So if you want to book an hour with me, you can go to my website, www.joeasimo.com, www.joeasimo.com, and you can schedule a time where we can do a one-on-one deep dive. So let's get down to the topic at hand, and cash flow management, staying profitable through real estate cycles. I suppose the issue is what does it take to stay profitable through market cycles? More specifically, the question is, why is mastering cash flow management crucial for real estate investors to weather market cycles? As I said before the intro, business goes through ups and downs. Real estate goes through ups and downs. And these gurus always talk about how easy it is. All you got to do is buy a house. I think this guy was saying he'll teach real estate investing in 3 simple steps: get in, get out, get paid. In 3 easy steps. Now we all know it's not as simple as that, and so it takes a lot more to be successful in real estate investing, especially given the realities that we go through cycles. So so cash flow management, money's going in and out. It's really the lifeblood of real estate investing. Whether you're a new investor, seasoned investor, intermediate investor, staying profitable. I highlight the word profitable through ups and downs of real estate cycles is absolutely critical, and therefore it requires, in my opinion, a deep understanding of how to maintain positive cash flow. Because as I said before, markets always fluctuate. Economic recessions occur, housing booms and busts occur, and there are also a lot of external factors that weigh into real estate investing. For example, interest rates. I think the Federal Reserve reduced the interest rates by 0.5 point today to try and spur the economy and to avoid going to a recession. So these things happen, and there are external factors that are beyond your control that you have to factor in. And so as as an investor, the key, in my opinion, to success is not just making money during the good times, because we all can make money As the saying goes, was it a rising tide lifts all boats? So when the market is going good, you're thinking you're fantastic, you're a genius, you figure this stuff out. But in reality, the market is what's lifting you up. But the issue then, because what happens when the market tanks or goes down? I think it was Warren Buffett who said, I think it's the same. You can tell a naked man when I forgot what that's saying. You can tell what it is. It's like you can when when the tide goes out or something to that effect. I think you guys know what the saying is. Please put it in the chat box and I'll repeat it again. But essentially, when the tide goes out, you really know who's swimming naked. In essence, who is really the real deal and who is really just blowing a lot of hot air and who really was successful because of the market. So the issue then becomes, how do you sustain yourself? How do you sustain profitability during downturns and uncertain periods? Okay. And, it's easy to buy high and buy low and sell high. Okay. And, the issue then becomes, how do you generate income during the downturn? And that's what we're going to do today, is go to do a drill down into these factors, but focusing primarily on cash flow management that will allow you to survive during the tight markets. Okay, so without mastering these skills, cash flow management skills, you're going to risk certain risks. You're going to risk over leveraging, i.e., putting too much debt. Debt is great. It can help you build your portfolio, but debt is a two-edged sword. It can wipe you out, especially if you can't pay the debt. It can be an albatross around your neck, and that's what usually brings a lot of people down. So there are risks associated with over leveraging. There are risks associated with cash flow shortages, and if you're not careful, you could lose your property and so forth. Okay, so ultimately, cash flow management allows you to build what I call a resilient portfolio, a portfolio that's going to pass this test of time and provide you stability over the long term. Okay, so that's what we're going to do today. So let me break it down to 6 steps. That's the focus of today. 6 steps on cash flow management and why it's important for real estate investors. So let's go to number 1, the basics. I'll start off with the basics. The basics of cash flow management. What is positive cash flow and why is it so important? Obviously, I'm assuming that you guys all know what positive cash flow is. But there may be some people who's thinking, what the hell are you talking about when you talk about cash flow? Positive cash flow. So the issue then becomes, the question I suppose is, how can you ensure your real estate investments generate positive cash flow consistently, and through good times and bad times? And that's one of the reasons why I do Section 8, because there's a consistent income stream, whether you go through good times and bad times, whether the tenants lose their jobs or whether they don't. As long as they're in their house, the money's coming in. That's one of the good side of Section 8, and that's one of the reasons why I decided to focus on that. And that's why, being in this program for at least 35 years, I've been a landlord in this program. There has never ever been a month whereby, as long as a tenant was in the house, I didn't get the money from the housing authority. So it's a very, very reliable income stream and something that you can bank on once you understand what's going on. So how can you ensure real estate investment generate positive cash flow consistently? Okay, so let's keep going. Positive cash flow refers to the surplus of rental income after all property expenses are paid. So you got income from the rents, some money's coming in, and obviously money's going to go out. Things like mortgage payments, property taxes, insurance, maintenance, property management fees. These are things that are going out. Okay, so when I talk about positive cash flow, it's the income coming in, subtract the expenses going out. Okay, so that's how you get positive cash flow. Now, a lot of investors, obviously, myself included, I buy in properties where there's a good chance of appreciation. Okay, but you got to be careful about just buying properties based on appreciation, because appreciation is not always guaranteed. So you have to make sure that the asset, the property, can pay for itself. So it's got to at least support in itself, preferably has cash flow, positive cash flow. Because if you don't have positive cash flow, it means that every month you're putting money out of your pocket and taking care of expenses there. Okay, I think it was I forgot who was it. There were alligators. Alligator. I think it was what's it? Robert Kiyosaki. So an asset is something that pays you. A liability is something that it's almost like an alligator. It eats you. So you want to have cash flow, positive cash flow, so that way it's paying you. It's an asset. It's an investment. It builds up over time. Okay. So I've tried it both ways. Positive cash flow is always better than negative cash flow, believe me. So the important thing is, okay, so you're going to get positive cash flow. You're going to have some excess money left over. So what do you do with that? Savvy investors like you and I are going to reinvest our profits to grow our portfolio. That's what I did when I was in the growth stage of my investing. The idea was that I would buy an asset, generate positive cash flow. That positive cash flow I would save, and over time those savings will increase, and then I'll use that money and plus other things to buy more property. So I was building my portfolio and using one asset to allow me to do that. So if you can get positive cash flow, you can leverage the funds that you have to start growing your portfolio. You can do new acquisitions, you can do property upgrades, you can improve the property of the house, or you can even use that to pay down the debt that you incur on the asset. So this is really the key to financial independence. By paying down your debt, building your portfolio, making some property upgrades so you can attract quality tenants, you can therefore be on your fast track, I would say, towards financial independence. It gives you the flexibility to do things that you would not be able to do if you were having negative cash flow. Okay, so investors like you and I, it's a dynamic process. We have to monitor our assets. We can't just buy a house and say, okay, well, I've got positive cash flow, I'm all done. No, there are times you have to monitor it. You got to track it. There are vacancies, there are expenses, there are things that you can do to increase your cash flow. Or if you just ignore it, you never know. It could come a time whereby you're actually losing money and so forth. Okay, so it's really important to monitor and then adjust appropriately whenever the market changes or the market shifts, and you have to be proactive and do things like that. Okay, so the important thing is to remain profitable without draining your resources. So that's the difference between thriving and surviving as a real estate investor. It's all about positive cash flow. So what are some of the action items that you can do as it pertains to that? Obviously, you want to calculate, you need to understand how to calculate positive cash flow and track it. Track your monthly inflows and outflows for each property to determine exactly what you're doing. I track mine. There is software out there. There's property management software. You can use Excel. You can use Google Sheets to track the inflows and outflows. There are tools out there like, there are property management softwares. You can even use QuickBooks. Obviously, in order to track your investments or your positive cash flow, you may want to adjust your rents appropriately. If your rent is too low, maybe you're leaving money on the table. But likewise, you don't want to overprice your property whereby it's hard to get tenants. And then another way to get positive cash flow is to reduce your operating expenses. So track your expenses with a focus on reducing those expenses. In my opinion, the biggest expense that you're going to incur are vacancy and turnover effect, costs. And that's the reason why I pay particular attention to making sure my tenants are happy, because if they're happy, they're going to stay longer, they're going to pay their rent, they're going to take care of the property, and so forth. As you know, my longest tenant is 27 years. 27 years. I have 20-year tenants, 18-year tenants, 15-year tenants, 22-year tenants, and so forth. That's not by accident. That's by understanding that my biggest expense is turnover and vacancy, and therefore I need to minimize that and so forth. Okay, so let's go to number 2. We've done number 1, which is what is positive cash flow. The next one is you need to understand market cycles. How do economic changes impact your cash flow? So the question is, what are market cycles? and how do they affect your real estate portfolio? As I said earlier on, all good things come to an end. Real estate is just like anything else. It goes through business cycles, and you need to understand what these cycles are. So the real estate, as I said before, it goes through phases, like almost like a sine curve. I don't know if you can see my hand. It's a sine curve, and there are periods of what we call expansion when the market's going good. At some point, it goes to a peak, and then it goes through a phase what we call contraction when it's slowing down, and then ultimately it goes through another phase called recovery. So there are 4 phases through a real estate cycle. There's expansion, there's peak, contraction, and there's also recovery. So understanding these cycle phases is really critical because it's going to impact you as a real estate investor. It's going to impact things like the demand for your property, whether it's renting it or flipping it. It's going to affect property values. Will they increase or decrease? It's also going to affect things like rental rates. Are you able to increase your rents or not? And your ability to maintain positive cash flow. So market cycles have a direct impact on your cash flow and so forth. So during periods of expansion, when the market's going good, everyone's all happy, prices are going up, and everyone's all excited, then during those phases, typically rents rise because there's a lot greater demand. Vacancies are low because a lot of people are looking, and typically investors experience increased positive cash flow. Okay, during expansion phases. Now, conversely, during recession phases, typically what happens is that vacancies increase, rental rates may drop, and property values may decline. Okay, and which can negatively affect your cash flow. So knowing what cycle you're in will help you to, you're going to have to adjust your strategy accordingly. So for example, in a downturn, you might focus on increasing tenant retention, making sure tenants stay on time, reducing vacancy periods, or even negotiating lower service contracts with your vendors to maintain profitability. Conversely, during periods of growth, you may be able to increase your rents. You may be able to refinance, your higher interest rate loans for new loans, lower interest rates, and also you may want to consider acquiring more properties to expand your portfolio. So by managing or mastering, I suppose, the dynamics of market cycles, it allows you, the investor, to position yourself to take advantage of opportunities that are going to exist and at every phase of the cycle. Okay, so it allows you to make strategic decisions, and which will then allow you to make profitable decisions, and therefore hopefully be maintaining your cash flow through each different phase. So what are the action items as it pertains to understanding market cycles? Real estate is very localized, so understanding or monitor your local market data, what's going on locally wherever you are. Keep an eye on key indicators like vacancies, vacancy rates, rental rates, economic growth, to understand where the market is, where you are locally. You may want to consider diversifying your portfolio, spread your investments over different markets, different types, and to mitigate potential risk, with market cycles, and prepare for downturns. You don't know when it's going to happen, but prepare for it. Build up cash reserves, secure lines of credit so you can tap into reserves if and when you need it, and just be prepared for downturns if and when they occur. So that's number 2. Let's keep moving. Hopefully this is good stuff. Let's go to number 3, which is managing expenses. There are 2 sides to this ledger. There's income, revenue, and there's also expenses. So what are the key areas where you can optimize your costs? I suppose the question is going to be, how can you optimize your expenses to maintain profitability in every market condition? So how can you and I as investors optimize our expenses to maintain profitability regardless of the market cycle that we're in? Every dollar that you save on the expenses, obviously it helps in improving your cash flow. And so while rent is largely market driven, you don't typically, there's only so much you can control about the rent. because that's based on the market conditions locally. What you do have the most say are expenses, and the expenses are more in your control. And that's the reason why I focus on minimizing my expenses, which is primarily turnover and vacancies, because to a certain extent, there's things that I can do there to reduce that. So operating expenses such as property management fees, maintenance, utilities can be used to improve your bottom line. The goal is to run properties as efficiently as possible without sacrificing tenant satisfaction and property quality. So one of the most effective ways to reduce expenses is through preventative maintenance. I told you about turnover and vacancy costs. Addressing, as it pertains to preventative maintenance, addressing issues early prevents costly repairs in the future. It also keeps tenants happy and satisfied, and also reduces vacancies. Okay, so don't neglect repairs. One of the things that ticks off a lot of tenants is that there's stuff going on with the house or the apartment. They call the landlord doesn't do anything. The landlord just blows them off, and next thing you know, they get irritated and then they leave. Okay, or the problem gets more expensive since you've ignored it. So another thing you can do to reduce expenses, consider things like energy efficient upgrades. If you're paying utilities, you may want to consider solar. There are some people that are, you can put energy efficient systems in the house, whether it be HVAC systems, light bulbs, and heating systems, and so forth. That may be attractive to eco-conscious tenants who are into that kind of stuff. Another cost-saving, measure is to streamline your property management processes and leverage the technology to automate things like rent collection, maintenance requests, and tenant communications, because these can reduce your overhead and increase your efficiency. It's also important to revisit your expenses regularly, check things out, look at your expenses going out, and make the necessary adjustments if and where that. So please keep a close eye on your expenses to ensure that your cash flow remains healthy regardless of the broader economic conditions. So what are some of the action items associated with managing expenses? Conduct regular audits, expense audits anyway. Review all your property related expenses quarterly to identify areas where you can cost a cut. Okay, invest in energy efficiency systems, heating systems, hot water heater systems, light bulbs, and things like that. Preventative maintenance is another way whereby you can manage and maintain, minimize expenses. Do a lot of preventative maintenance if possible, and hopefully you can nip the expenses in the bud before it gets kind of crazy. I have home warranties on all my properties. That usually typically covers things like the electrical, plumbing, heating systems, the appliances, and things like that. So if something goes wrong, I call the home warranty company. If they can fix it, they fix it. If they can't, they usually recommend replacements, and that way I kind of limit my out-of-pocket expenses for major systems. So that's number 3. So we're kind of halfway through. And so again, if you got some questions, please put them in the chat box. I'm going to go to the Ask Dr. Joe segment, the Q&A, very, very shortly. And for those people who have got some issues, problems, challenges that they want to discuss with me in a deeper environment where it's one-on-one, you can also book a one-on-one with me. Just go to my website, www.joeasamoah.com, www.joeasamoah.com. And every single one I've done, people have been very, very happy. There's no point in recreating the wheel. There aren't too many scenarios and situations I haven't seen in my 35 years worth of experience. So it's really unnecessary to make what I call unnecessary mistakes. Don't do it. Leverage people like myself or other people who are more experienced, and hopefully you can leverage on their experiences and the mistakes that they've made, so you don't have to make unnecessary mistakes. So book a session with me if you think it's appropriate, and www.joeasamoah.com. Okay, let's move on to number 4, optimizing rental income. How can you maximize revenue? Okay, without increasing your risks. Okay, I suppose the question is going to be, what strategies can you use to maximize your rental income and to minimize your vacancies? Okay, what strategies can you use to maximize income and minimize vacancies? Okay, so the key to increasing cash flow often lies in maximizing rental income and minimize or optimizing expenses. Okay, over time, you may want to consider increasing your rent because if you don't, you're leaving money on the table. While it's important to remain competitive, you don't want to be overpricing your properties. It's usually easier to do incremental increases over time, little increase over time, rather than not increasing your rent and then having to make a big, huge rent increase because your rents are so far below market. Okay, so I would suggest that you do incremental rent increases if possible to improve your cash flow. And also, it allows tenants to not feel the pain so much. So you avoid kind of alienating your tenants. So reducing vacancies is another essential strategy, and which means essentially keeping the tenants, get the tenants to stay in your house longer. Turnover expenses are huge, and you got to minimize that. Otherwise, you really don't make any money. So reducing vacancies is a very important strategy. Because they'll drain your cash flow if you have empty units. And you're still going to have to pay the property taxes. You're still going to have to pay your mortgage payments. You still have to pay utilities if necessary during this time, even though there's no income coming through. That's why I pay so much attention to turnover and expense costs. So the things that you can do, effective marketing, tenant retention strategies, and offering incentives such as flexible lease terms can also help reduce your vacancies, and increase your cash flow over a period of time. So finally, also consider additional revenue streams like charging for parking if that's possible, offering furnished units because furnished units usually command more rents than unfurnished units, and implementing things like pet fees and things like that. So those things can increase your income flow and could potentially turn a negative cash flow property into a break-even or positive cash flow. So look at strategies you can do to increase your income, i.e. get some additional income without significantly increasing your operating burden. So what are some of the action items here? Things like implement annual rent reviews, review your rents and make adjustments accordingly. Minimize vacancy times, i.e. whenever you have a vacancy, try and turn it around as fast as possible so you can get the property back on the market. And also explore additional revenue streams, things like parking fees and things like that. Okay, let's go to number 5 of 6. And this one is building a cash reserve. Why is having a cash cushion critical for real estate investors? You got to have a cushion, okay? It's absolutely critical. Why? Why is that important? Because building and maintaining a cash reserve protects you during unexpected market downturns. If you got cash set aside in a rainy day fund, in reserves or whatever it is, if something unexpected occurs, you got a cushion there. You got something that you can tap into that will keep you going. If you don't have it, then you're gonna have to borrow money, or you're gonna have to, you're gonna have to figure something out real fast. So building a cash reserve is really one of the most critical elements for that successful investors implement. Okay, it's really important for your cash flow management. It's really important for your stress level. It's really important. It's often overlooked by a lot of real estate investors. A cash reserve, essentially acts like a financial safety net, giving you the ability to cover unexpected expenses, and emergency repairs, vacancies, or sudden shifts in the market. You've got some reserves that you can tap into for a rainy day. Without an adequate reserve, investors may be forced to rely on sort of expensive short-term loans, okay, or credit credit cards just to tie you over because you don't have the money to take care of whatever that expense is. And that will negatively impact your cash flow, which obviously can erode your profitability. So, a general rule of thumb, a lot of people ask me, well, Dr. Joe, that sounds good, but how much reserve should I have? I normally recommend to have about 3 to 6 months of operating expense reserve set aside for reserves per property. Okay, so set aside about 3 to 6 months worth of reserves, just in case per property. Okay, and these reserves should be able to be easily accessible, and it should only be used for emergencies only. Okay, it's not there to go to Las Vegas. It's not there to have a good time. It's not there to party. It's there for emergencies, because emergencies do occur, it will occur, and you have to be ready for them. So by having these liquid funds available, it can help you avoid the financial strain that comes with, things like covering your mortgage, taxes, insurance, and other expenses during times when you may not be having rental income. Or your income is being reduced. You can tap into this rainy day fund, and then that will help you to sort of survive and during this difficult time. Additionally, having cash reserves allows you to take advantage of unexpected opportunities. During downturns, a lot of people experience hardships, and if you have the ability to buy, that's when the best deals are. Is during downturns. It tends to transition into a buyer's market where the buyers have the upper hand. So if you are a buyer in a buyer's market, you're able to get better deals. And the best way to do that is to have some reserves and be able to pull the trigger during downturns. You do get some really good deals if you can hold on to these assets until when the market goes up. Then if you want to, you can cash out at that time and make quite good return on your money. So cash reserves are not just about protecting your downside. Okay, it's also allows you to empower you. It empowers you to grow your portfolio significantly. During bad times. And so I look back now, and I think the best deal that I've got is usually during the hard times, during market downturns, versus buying during seller's market where the sellers have the upper hand. So what are some of the action items associated with cash reserves? Set targets for your cash reserves. Regularly evaluate your reserves and make sure you got enough, and create a separate emergency fund that you can set aside and keep it away from your regular operating accounts, so that way it's set aside and you can use it for a rainy day. And then finally, number 6, leveraging financing options. Financing obviously is key to during market cycles and cash flow. So what are the best ways to use debt to boost cash flow? And I suppose the question is, how can real estate investors strategically use financing to improve cash flow and profitability? How can you and I, as investors, strategically use financing to improve cash flow and profitability? Well, financing can be a powerful tool for real estate investors, but it needs to be used wisely. Okay, as I said earlier on, debt can be a double-edged sword. It can be your friend, or if you're not careful, it can slice your head off. It can take you down. Okay, and so be careful. So how you use debt, you can structure it in such a way that it improves your cash flow without over leveraging. You don't want to over leverage, because if you over leverage, i.e. put too much debt on a property and the property prices go down, if you're not careful, you could be underwater, i.e. the amount of debt on the property is more than the value of the house. So there are various financing strategies that you can use to help grow your portfolio while keeping your monthly expenses manageable. Things like long-term fixed rate financing is usually pretty good. You can lock in low interest rates when the market is slow, and which allows you to have predictable monthly payments, which then allows your cash flow to be more stable. Another effective approach is refinancing. You know, when the market's slow or when interest rates are lower, this is a good time to refinance. I mean, I know interest rates are going down now. It's still relatively high compared to what it was 3 or 4 years ago, but it's certainly historically it's not bad. I think the rates now are kind of the mid sixes now, which is not bad. And but the thinking is that the rates are going to go down. It may even go to the upper fives at some point in the next few months. So refinancing properties, especially if you've got higher interest rates, is a good way to increase your cash flow and take advantage of opportunities. Another people do is tap into home equity lines of credit, HELOCs. So if you've got some equity in the house, then or in the property, you can tap into that in order to be able to have some reserves, have a rainy day, and also even to acquire new properties. But again, always try to avoid over leveraging by taking on too much debt relative to the cash flow that you have. In a market downturn, as I said before, high debt levels can really become a burden, and it can take you down. I've seen so many people being wiped out because they were just over leveraged, and you don't want to be in that situation. So what are the action items as we wrap up today? Leveraging financing. Evaluate your financing options. As I said, there's quite a few options you have available. Consider refinancing and also use leverage wisely. So in wrapping up for today, conclusion, how can you achieve long-term success through cash flow mastery? So I suppose the question is going to be, what are the most critical steps to ensure long-term profitability and success as a real estate investor? What are some of the critical steps that you can use, you can implement to be a long-term player, be around for a while, and be a successful real estate investor? What are some of those things? So, in summary, mastering cash flow management is really the cornerstone for long-term success as a real estate investor. You've got to nail this. You've got to understand how the inflows and outflows of money. You just have to. There's no sure way around it. And as I've explored today in today's live stream, there are multiple strategies that investors like you and I can use to keep cash flow positive, minimize risk, and also capitalize on opportunities that may present itself in various market cycle phases. Whether you're starting out or you have an established portfolio, consistent cash flow management is really a key to scaling your business. It's really important. If you want to get financial independence, you're going to have to understand and master cash flow management. So, real estate investors like you and I, we need to understand these things. We have to be able to withstand market fluctuations. The market will go up and down. We need to have a consistent, stable income flow. That's why I do Section 8. And also, hopefully, you'll assemble a portfolio of appreciating assets that will increase over time. So by focusing on things like rental income, reducing operating expenses, managing debt strategically, and maintaining healthy relationships with tenants, you can really protect yourself and ensure consistent profitability and ensure a consistent income stream. So, my friends, the journey to financial independence is not just about making money, although it's important to make money. It's about building a sustainable system that supports your long-term goals, even during economic downturns. Good times will go to an end. All good things come to an end. You got to be able to survive during those things, during those times. Otherwise, you're going to get wiped out. So as you implement your strategies discussed today, remember, consistency and adaptability are the keys to thriving in real estate. With the right mindset and tools, you can navigate market cycles, protect your portfolio, and hopefully achieve long-lasting success. My friends, that is it for today. Let's get a Q&A. If you've got some questions, please put them in the chat box. I'll try to get to them as soon as I can. If you want to shoot me an email, you can reach me at joe@joeasimo.com, joe@joeasimo.com. And also, if you want to book a one-on-one with me, where we can do a deep dive into any particular issue, problem, challenges that you have as a real estate investor, please go to my website, www.joeasimo.com. Press the button Ask Dr. Joe, and you can schedule a one-on-one with me for an hour, and we will dive deep into whatever issues, challenges, problems that you are facing. So, my friends, let's get down to the Ask Dr. Joe section, and I will see if I can answer some of your questions. Let's have a look. What do we have today? So greetings from Phoenix. Hey, Dao2, how you doing, man? Hope you're doing well. And I got my usual regulars here. Wealth and Wellness with Grace. Hey, Grace, hope you're doing well. John Mark Stevens, greetings from Mobile, Alabama. Thanks for sharing your wisdom with us, Dr. Joe. No problem. I enjoy sharing. The pie is big enough for everybody. It's okay. So Fed's cut rates by 50 basis points or 0.5% today. Yippee. So if you are looking to refinance, this is the time to consider it. If you're looking to grow your portfolio, this is a good time to consider it, and so forth. So yeah, it's gonna be good. So good evening, Aman. Hope you're doing well. And let's have a look. Aman, would you say your rating of a neighborhood outweighs your rating of a great property potential? Good question. Would you say, let me just repeat again, would you say your rating of a neighborhood outweighs your rating of a great property potential? So I know for Section 8, which is where most of my tenants are, neighborhood trumps everything. They will more likely, and I think you would as well, you would more likely to select an okay house in a better neighborhood, versus a beautiful house in a crappy neighborhood. Okay, so let me ask you, what would you choose? A crappy house, a beautiful house in an iffy, I won't say crappy, in an iffy neighborhood, or will you choose an okay house in a better neighborhood? Okay, what would you choose? My experience is that I will personally prefer to buy in okay neighborhoods and not have to do all the bells and whistles, but it's an okay house, because the tenants I'm trying to attract, which is the tier 1 tenants, they look at neighborhood first. Crime, safety, security, recreation, shopping, transportation, schools. These are things that are important. These are neighborhood oriented amenities. And if, I'll tell you one story. Okay, so I used to, there's nothing worse than you an investor, you bought a house, you rehabbed it, you spent all your hard-earned money fixing this place up, okay? And, because you did it because you bought the house because it was a quote-unquote a good deal, okay? And so you're doing all this hard work, and now it's time to rent, or now it's time to flip this property. And then you find out that the neighborhood gangsters, live a couple of doors away from you, or the neighborhood, problems are just a few doors away from you, okay? So now your house is for rent, or now your house is for sale, and people are coming. And when they come to your street, the first thing they see is the neighborhood gangsters, the troublemakers, the problem neighbors, or whatever it is. I've been through that. It's not pretty. What happens is that the good people will say, they take a look at the street, at the problem, and just keep driving. They're not even going to stop the car and go in your house. So you spent all this money fixing up your property, and people aren't going inside to see it. It's not a good feeling. And then you have to offer stupid stuff in order to get people to see your house. You got to offer things like free toasters, or free vacation. I mean, it's crazy stuff. So so to answer your question, Aman, I would say neighborhood. I would be more inclined to pick a okay neighborhood and an okay house versus a great house in an iffy neighborhood. So I would agree with you. Would you say that rating of a neighborhood outweighs? It does, in my opinion. That's just my opinion. If you disagree, feel free to provide your perspective. That's just been my experiences. Dow2, you don't find who's been swimming naked until the tide goes out. There you go. That's Warren Buffett, 1994 annual meeting. Yes, the point is that when the market's good, everyone thinks they're great. Everyone thinks they're the greatest thing since sliced bread. They think that they're Superman, Supergirl, Superwoman. And but in reality, it's the market That's what's and the case in point would be like flippers. They overpay during the good times. They overpay to buy a house. They overspend on the rehab, and then because the market has gone up, they sell higher than what they because the market's gone up, so they can sell higher, and therefore they've been able to still make a profit, even though they overpay for the house, even though they overpaid on the rehab, they're still making money, and so they're thinking they're great. When there's a downturn, if you overpay for a house and you overpay for on the rehab, the market is not going to bail you out. The market may not go up. In fact, the market go down, which means that you're going to lose money. You're going to lose your shirt. Okay, so you're thinking you're doing great. You're a great rehabber. You're a great investor, but in reality, it's the market that's what's bailing you out. So you really don't find out who knows what they're doing until the market turns. And that's the saying here by Warren Buffett. You don't know who's swimming naked until the tide goes out. So that's been my experience. I've been through 6 of these cycles, so I have a pretty good idea how this plays out. And believe me, I'm not bragging, but I know what I'm talking about. And I've been time tested and battle tested. And it's not, downturns are not pretty, but they do offer opportunities for those people who are ready, have the systems, have the cash flow, have the reserves to be able to take advantage of these opportunities that occur. Okay, Catherine Hawkins. Have you ever done shared housing with specific groups, i.e. homeless veterans that can get a HUD-VASH voucher? Okay, good question, Kathy. I haven't done shared housing. Well, no, not for instance, to homeless or veterans and things like. I haven't done that before. That's not my expertise. Typically, I buy a house, and rent it to voucher holders, the entire house, as opposed to rent by the rooms or or share the tenancy. I haven't done that before. I know some people who are doing that and are very, very successful. So it's a niche that some people are doing very, very well. Using the VASH voucher, which is primarily for veterans. The government's pouring a lot of money to help homeless veterans, and I know some people are doing very well in that strategy, in that niche. I just haven't done that, so I really am not an authority, Kathy. But I do know. My suggestion is that if you're thinking about entering that market, then you may want to do some time, take some time to do some research to find out people who are actually doing it. People who are successfully, operating in that niche, so they can share with you the do's and don'ts. They can share with you, the things based on experience, the lessons learned that they've had. And so therefore, hopefully you can learn from their mistakes, you can learn from their experiences, so you can get to where you need to go to a lot faster. So although I haven't done it before, there are people who are. So your challenge, Kathy, is to do the research to find these people and incentivize them to help you. So that way you can learn from their experiences rather than you trying to figure it out yourself. There's really no need to recreate the wheel. There's people who are doing this well. You need to go and find them. I don't know where you are, Kathy, which part of the U.S. you're in, whether you're in the D.C. area or outside. But there are people. You may want to go to some RIA meetings, Real Estate Investor Association meetings, or do some research, and then I'm sure you'll find some people in your local area, and so on. So, good question. I'm getting some good questions. 7:50. Got a couple more minutes. Again, if you got some questions, please put in the chat box, and I'll try to get them, before the end of the show. Melissa, hi, Melissa. Hope you're doing well. And give us an update on how your property is going along. And also, I think last time you were talking about an issue you had with your real estate agent in terms of your down payment and so on. Please give us an update on how that's coming along. Okay, what do we have here? Wealth and wellness with Grace. Again, if you got some questions, please put them in the chat box and I'll try and get to them. Wealth and wellness with Grace. I am looking forward to the one-on-one with you. Okay, I have a question about how to capitalize on the equity on my portfolio. to grow and expand. Okay, well, I'm looking forward to the one-on-one with you, Grace. I got to check my schedule to find out exactly when our one-on-one is. I'm looking forward to that. I'll be more than happy, hopefully, to share with you my thoughts on how you can leverage, the equity on your portfolio to grow your on your property to grow and expand your portfolio. As I said earlier on, um, from my experiences, when you first start, money's tight. It's difficult. You don't have the network, you don't have the resources. So it's a struggle, and so on. But at some point, you do acquire property, and if you hold on to it for a little while, it generates equity. Prices go up, and therefore the issue then becomes, what do you do with that equity? And I used to tap into that equity, and I use that equity to buy more properties. So one asset will then buy more properties, and that's one of the strategies that I use. And that's a strategy that you could possibly do as well, because we do go through what I call a growth phase, where we're trying to build a portfolio. And during that time, it's really, I would rather, if, let's say for example, if I had $100,000, would I use that $100,000 to pay off a $100,000 mortgage, for example, or would I use that money to as down payment to acquire more properties? Okay, so depending on what phase you are in your real estate career, if you're in the early stages or during your growth, I would suggest that you use that $100,000 to acquire more properties, because you'll get a better return overall. Now, there'll come a time whereby you have enough properties. I have a lot of properties. I don't think I need any more. So at that point, maybe it's preserve. For me, it's preserve and protect. It's preserve that income flow. It's protect that the portfolio, and maybe pay down some loans. So again, it depends on where you are in the real estate life cycle. But if you're in the growth stage, I would strongly recommend that you consider building a portfolio, because you'll make more money by owning a larger portfolio rather than having a couple of fully paid off properties, in my opinion. Again, it depends on each person's situation. But if you're in an appreciated market, I would strongly suggest that you consider acquiring a portfolio, holding on to this portfolio, and therefore now you have multiple properties working for you. You got multiple properties that are generating cash flow. You got multiple properties that are building equity. You got multiple properties that have tax benefits, and overall, I think that it's a better allocation of resources. Okay. Kathy is in McLean, Virginia. So McLean, Virginia is just outside of Washington, D.C. area. And there's a large veterans community in the D.C. area. So I'm not too sure how big the VASH program is in McLean, Kathy. But I know in the D.C. area, there's quite a bit of money, especially in Washington, D.C., where you can, implement that program, or and so on. So I would suggest that you consider finding people in the DC area, the McLean area, who are successfully operating in that niche, the VASH program for homeless veterans, and learn from them. Find out what works, what doesn't work, what would they do if they had to do it again differently, and hopefully you can learn from their experiences, so you can get to where you need to go to a lot faster. Hopefully that was helpful, Kathy. Again, if you want to book a session, anybody wants to book a session where we can do a deep dive into any particular question or issue, then we can do that. Also, I'm working with other investors to start building duplexes for sale and others for rent. How would you structure that partnership? Oh boy, good question. You got some good questions, Grace. Okay, so partnerships generally, just be careful. I see partnerships as almost like the same as marriages. If you marry the right person, life is good. You got two people swimming in the same direction, and so on. So a partnership is really good if you got the right partner. Now, if you got the wrong person, you marry the wrong person, you got the wrong partner. You got personality issues that come into play. People may flow in different directions. People may have their own separate agendas. So it can be very, very challenging if you got the wrong partner. So be careful and do your due diligence on your partners before you go into them. these things usually start off well. Everyone's all happy, but you really don't know anybody well until you know people's true colors come out during bad times. When things don't go right, then you really find out who you're dealing with, and so on. So yeah. So yeah, to answer your question backwards, how do you structure the partnership? I think you'll want to have a strong partnership agreement. You may want to get an attorney to draft it up. I would definitely sit down with the potential partners to clearly understand where they're coming from, what their goals are, what their objectives are, and they understand what your goals or what your objectives are, and craft and document this, especially what if scenarios, what if this happens, what if this unexpected things happen, how are you going to navigate through that. So get some legal advice and make sure you document everything, and that way all parties are going in there with their eyes open. So you're working with other investors. Typically investors, you got some people that are bringing money, and you got some people who are bringing expertise. You got to figure all that out. What's the allocation? What's the equity split? And all that. How much money needs to be brought to the table? Who's doing what? What's the roles and responsibilities? There's a lot of things to do. So it's something you should not go in lightly. But there are advantages in partnerships, definitely, because you can accomplish a lot more than if you're trying to do it all yourself. So I definitely think you're on the right track, Grace. But I would say proceed with caution. Do your due diligence and make sure that all your potential or prospective partners are on the same page. Okay, 7:57. I got a couple of minutes left. What numbers do you look for when buying if no rehab needs to be done? This is from Nardang. Okay, what numbers do you look for when buying if no rehab needs to be done? Okay, so you're buying a house, no rehab, so it's almost like a turnkey, I assume. And it depends what's your how much you're paying for it. It depends what your long-term goals are. When I first bought my first house, believe it or not, I was making $50 cash flow, $50, and I was having the tenant from hell. It was a disaster, but I stuck with it, and 35 years later the cash flow is now 4,700. So at the time it didn't make any sense, but now it makes a lot of sense. I bought a house for 47,000. Houses in that block are now going for 750,000. So I would say, again, that's not to brag, but it just depends on what your end game is. If you are a long-term player and you are buying a property in a appreciating area where it's likely to grow in time, then my thing is let time do the heavy lifting. Let time do the heavy lifting. What you should focus on is making sure the asset can support itself, but also making sure you get good tenants. You screen tenants. You get the right tenants in there who are going to pay the rent, take care of the property, no drama, and hopefully stay a long time. Because if you can accomplish that, then you'll get bigger returns over the long haul. Over the long haul, real estate in most areas is a good, solid investment, but you've got to be able to survive the long term. And that's where you got to have good tenants, good systems, good relationships, and things like that. So hopefully that helps, And it's not as simple as that, but hopefully that's a good idea. What numbers for cash on cash? Again, it depends on your situation. It's now 7:59. I got about a minute left. I got a whole bunch of questions. The reno for my single family in Pueblo is going quickly and on budget. Good, congratulations. Problem is that I'm just not sure if I can keep as a rental or just flip it. Depends on the percentage rates as I refi, I suppose. Okay, so it looks like Melissa's back on track. She had a couple of properties that she was buying, and they kind of fell through, but I think she's picked herself up and moving right along. So keep it going, Melissa. And so what did I say here? What's this one? Reno, I think I've done that question. And I recently renovated and rented a Burr property, but need to wait a year to refinance. What are your suggestions for managing the extended time with money left in the deal? This is from John. I recently renovated it. Okay, so you bought a house, you renovated it, and you need to refinance. You got to wait a year. So it's probably like what do they call seasoning. And some lenders require you to hold on to the asset for at least 6 months, 9 months, or a year in order to refinance. That's called seasoning. What are your suggestions? Depends what you want to do. If you want to get some income, you're going to have to rent it. But if you rent it and you get the wrong tenant, they could destroy the house. But you don't want to have nobody in there because you still got the expenses of holding costs. So it's going to be, it's a tough one. Uh, if you're not, if you're going to do a burrow, which means you're going to rent it, um, you may want to look around, see if there are other lenders out there that don't have this seasoning requirements. There are lenders out there that don't require you to hold on to it for a year. So I would consider looking into that. You may pay a little bit extra, but it may be worth it because you'll be able to get it rented earlier, and therefore that will reduce your holding cost. So that's something you may want to consider, shopping around, see if there are other lenders that don't have these seasoning requirements. If you can't find anybody, then you may just have to wait. But I don't know. I'm not a great fan of just having a house sitting there empty. You may want to consider something like Airbnb. Maybe that may be helpful. That way you get some short-term income. If Airbnb works in your area, that could be but you're gonna have to, furnish the property. So there's some expenses there. But out of the top of my head, I would say check out some potential financing options. See if you can minimize that. Airbnb, look into that, and see if you've got other lenders that maybe instead of a year, maybe they can allow you to refinance in 6 months or 9 months or whatever it is. Because the holding costs can be quite expensive. It's now 8:02. I think we're done for the day. Quick one for Cleveland. Melissa, Cleveland problem. I was getting nowhere with my agent to get my earnest money back. I asked for his managing broker to step in. She left the seller agent 2 voicemail. So it looks like you're having an issue with. At the end of the day, it's going to depend on your contract, the purchase and sales contract, Melissa. What does that say in terms of getting your earnest money deposit back? It may be easy just to cut a deal, maybe give them something just to get the thing done. Otherwise, you're going to have to go into litigations or small claims court, and so on. Thanks so much for your responses. Okay, my friends, it is now 8:03. Hopefully today was a good one, and I enjoyed it. And so hopefully I'll see you next Wednesday at 7 p.m. Eastern Time. Again, don't forget, if you've got questions, throw me an email at joe@joeasamoah.com. And if you want to book a one-on-one with me where we can do a deep dive into your situation, your problem, any challenge that you're experiencing, go to my website, www.joeasamoah.com. And that is it, my friends. So I'll see you next Wednesday. Have yourself a wonderful week and take care. Bye for now.